Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, click that like button, and share these videos. As this week begins, we're going to continue to see plenty of volatility. We're far from being through this particular crisis. A lot of folks are talking about recovery rates and market cycles, previous declines, all that stuff. None of that matters yet. We still do not know what we're dealing with. In my opinion, we're 12 days into this crisis, and we're a long ways from understanding the amount of dislocation of capital that is occurring in the economy. Now, there are billions of dollars flowing everywhere, trillions of stimulus, the Fed is buying assets, all of those things are happening. But that does not mean that it's going to support the markets in a way that you might think. If you recall, back when TARP was done back in 2008, it was the midpoint of the decline. I continue to think that we're not through this crisis yet. Short-term patterns are consolidating, suggesting that maybe there's a short-term bottom, but there's a lot to unpack as we go forward. As I've said over the past several weeks, we're likely to see shock waves come, unexpected events that are likely to happen. I've talked a lot about the commercial loan market being locked up. We're looking at no jumbo loan creation going on right now. Real estate activity is at zero because nobody can even go look at a house. This crisis we're going through has far-reaching elements that it's very difficult to measure at this time. It is likely going to be substantial, and it's going to take a long time to fix. Those folks that are talking about V-bottoms in the market and the economy is going to come back and scream and everything's going to be back normal, probably not. I believe that a lot of folks' patterns will be changed. They're going out to restaurants, bars, all that stuff's going to be changed. At what point do people just go back out and go back to life as normal? The media has freaked out just everyone that's out there into not trusting even being around another human being unless you're really close to them. With this type of social environment, it's going to be very difficult just to get the economy back into full swing, acting like we did before, going to concerts and sporting events and all those things that we all enjoy. Most likely it's safe to do so, but it's going to be a hard time psychological to get people back into that mode. The event that we saw earlier today, this is Sunday, that OPEC they're cutting back 9.7 million of production. Well, that's positive, and crude oil was up about 1.5% last I looked. The equity markets aren't looking at this very positive. Most likely all they've done is brought the demand and the supply back in line. So there's no real bump that you're going to get out of this cut that I see anyway. A lot of folks trying to hype it up. Market participants don't appear to be buying into this scenario at all. As we go through this week, I looked at the economic schedule. Very little going on. Nothing is likely to be material other than the unemployment claims on Thursday. We've already seen about 17 million people file for unemployment. That's likely to continue this week, probably in a note of somewhere between 3 and 5 million more this week, which will put us over 20 million people in a 4-week period. This is unprecedented, and the impact of this can't even be measured. It appears to me that market sentiment is likely to be very sketchy going forward, and it's not going to take much to derail any positive thoughts. So expect to see some sort of corrective phase potentially start in the next several days. Let's take a look at the technicals and see what we can unpack there. Before getting into the technicals, I want to talk about the configuration of our database and what's going on. Where actually I would call, I hate to use this term, I remember back in 2008 somebody coined the phrase green shoots. Well, we're starting to see green shoots, and we're seeing some activity starting to get some traction in some sectors and some stocks. We're looking at equities now 27.52% long, ETFs 21%, mutual funds 13.70. So we're a long ways from anything exciting, that's for sure. But if we look down here at the different sectors, these are the green shoots. You see there was a slight rotation into basic materials, and the other rotation is healthcare, which makes some sense. telecommunications also. When we go down here and take a look at the different groups, you see there's some rotation going on in mining, paper products. There is some positive that's starting to come into play. And healthcare, once again, this is a breakdown of some of the subgroups within that sector that I mentioned earlier. Looking a bit deeper into the database, you'll see that we're seeing on a daily basis the short-term signals. We've now got 5,028 new longs that have come into the market over the past week and a half. We're at 30.62% long. I've talked a lot about this over the years, but a number over 40.2% starts to become positive. So I'll be watching this number, may mention it over the next several days. You can see the sectors that have come into play. Basic materials is up 11.5 in 8 days. 8 days of capital goods. Also conglomerates, consumer non-cyclical up 12%, and utilities up 8%. Now all of these trades are 8 days old. So that was 2 weeks ago when I told you about the short-term buy signal. Let's take a look at some of the specific industry groups. You can see also most of these are 8 to 10 days old, and they average between 6 and about 12% on the upside. So we have seen some short-term positive rotation into the market, which suggests there's likely to be some more consolidation before the market's in a position to go lower. Looking at the daily S&P futures, you can see they're starting to decline again. They're down about 1.2%. Also reacting along the lines of the 40-day moving average, which still has a negative decline of 0.56. I just posted a video that discusses how these PPM works. You might want to watch that. It's 5 minutes long. But take a look at that so you'll understand more of this dialogue that I'm talking about. What we're seeing on the PPM 3 at the bottom is a re-acceleration to the downside, telling us that this resistance that's at the 2776 level is substantial and is likely to move the market back to test the 10-day moving average, which is 2617, and possibly going as low as the 21-day, which is around 2525. I talked about that number mid last week. Let's take a look at the cash and see how that looks. Looking at the Fibonacci relationships, after the steep decline completed, you'll see that we traded within these ranges, and this right shoulder is set up, and now we're moving toward the 50% level, which is 2847. In Wednesday's broadcast, if you want to see more detail on this, I did some exact calculations from a Fibonacci standpoint where the market's likely to go, and the target zone was 2850, 2920 on the upside. It is highly likely that we'll see a top right in this level, and then we'll move back into these relationships, trading in a sideways pattern, likely to trade in a sideways pattern. The pattern that I've just drawn in is likely pattern over the next 8 to 10 days. But initially, we should see a reaction. The 40 should be a resistance point. We're going to start to see some crisscrossing of these averages. In this area here will be the area where markets are likely to consolidate in that pattern. Still have this gap way down here that needs to be filled. That presents some risk to the markets at this time. Now, if we were to break over 2847, then we could see a move up to that 2920 level. So this top area that I've just drawn in here would be where the likely extreme resistance will be. It appears based on overnight action that we're going to see some downside. The key number is going to be at the level I mentioned earlier at 2610 and then 2525 over the next several days. One of the things I look at in my analysis is the correlation between going from daily, weekly, and monthly. Sometimes I'll do a top-down view. Other times I'll do a bottom-up. We're looking at the bottom-up view, and you can see these Fibonacci numbers are the same. There's two elements here that are very interesting. The Fibonacci projections for this week's range suggest it could go as high as 3084 and as low as 2495. Most likely will trade between R1 and the S2 this week. So that suggests 2859 will be the high end of the range that coincides with the 50% retracement. And then on the downside, 2610 or 2642 will be the range where the support is likely to come in. The extreme level, as I mentioned earlier, will be 2525, but this weekly chart also shows that the 10-week moving average is coming in right at these current levels, 2880, and it's dropping at about 35 points per week. That puts it also at 2850. So we're not likely to get through that range at this time. So this is going to set up the potential for a beginning of a minor correction with the range projections between 2525 extreme, 2850 on the upside over the next 5 to 8 sessions. Taking a look at the Treasuries, we finished at 7.29 on Thursday. This looks like it's trying to make a turn again. This is the weekly graph. Still believe we're going to go up toward that 850 level, possibly as high as 1%. If we get above 1%, that's going to be a sign that there's some serious issues with the bond market. I've been willing to be somewhat patient with the bond market, but for now, I would continue to exercise extreme caution when approaching this market. I've said several times over past broadcasts, I want you to scrutinize what you own in the fixed area very highly, make sure it's of the utmost quality. But even here with Treasuries, it's going to be hard to nail down exactly what you should do. I continue to suggest that you not own any bonds at this time until we find out more about the crisis, more about the dislocation of capital. Gold is an interesting market. After the sharp rally that we saw last week, it continues to be in a positive mode, but once again, we're seeing the lack of follow-through on the PPMs. While they're still positive, suggesting that support will hold, the support's back at 1665. The support levels are substantially below where we're trading. My expectation is that around 1708 to the 1694 level will be the range where this market will hold for the next couple of days. A break under 94 will set a move back to 1665, and there's still vulnerability on the downside. This pattern is very unorthodox, does not appear to be an impulse pattern, but part of a larger corrective phase that's unfolding, going back when we went down to the 1450 level. Looks like an ABC pattern. It could be a double zigzag unfolding, which suggests that there's going to be a trading range, but the trading range should form above a minimum of 1630 on the downside with the upside of 1750s. The trends are still up on the short-term and intermediate levels. A quick view of the US dollar. It does appear that the dollar is very similar with gold. It's interesting that these tend to be moving in tandem, which you would think would not be the likely configuration. It does appear that gold and the dollar are trading almost hand in hand in the same directions at the moment. Downside on the dollar is still possible back to around 97.50. The spike that we saw up to 103 appears to be just that, a climactic spike, and a trading range between 97 and 101 is likely. The final market to cover is crude oil. This is the May crude, currently trading at $23.95. It is now up 5.23%, so we're getting a bounce still within this pattern that we've been trading at this low. Crude oil market is under substantial amount of pressure. There's rumors that people are selling actual crude out in the marketplace at $10 or below in some cases just to get cash. While the OPEC claims they'll change, I'm not sure that market participants will believe them. They don't have a lot of credibility. But over the next several days, we're likely to see what the market participants has viewed. But it does appear there's a low. We could go back towards the $30 level, but there's just going to be a lot of resistance. The PPMs are hugely negative, which suggests that in the next 2 or 3 sessions that the 10-period moving average is going to come into play, which is down 7.25% at the moment. It's going to keep a cap on this market around 30 if it can get up there, and possibly drive it back down toward the lows once it hits that level. So don't expect to see any miraculous trade in crude oil. As I mentioned in the opening comments, most likely all they've done is adjust the output to the demand. So there's not likely to be a big bump in a material way. This will complete the broadcast. Thanks for watching. We'll talk to you tomorrow night.